Good afternoon and welcome to the ECB press conference. I'm joined by President Lagarde, who is working from home today as she is still positive. I'm also joined here on stage by Vice President Luis de Guindos. In the Q&A session, please make sure to unmute yourself and to open your camera because we want to hear and see you. I will now hand over to Madame Lagarde for the monetary policy statement. President Lagarde, please.
Thank you very much, Wolfgang, and good afternoon to all of you. The Vice President, Mr. de Guindos, and myself are very pleased to welcome you to this slightly unusual press conference. Before I head into the reading of the monetary policy statement, I'd like to just express my gratitude to all the team members who have made this event possible in this way, and certainly also to my Vice President, Luis de Guindos, who has helped a great deal and stands ready just in case my voice disappears. So moving on to the monetary policy statement now. Russia's aggression towards Ukraine is causing enormous suffering, and it is also affecting the economy in Europe and beyond. The conflict and the associated uncertainty are weighing heavily on confidence of businesses and consumers. Trade disruptions are leading to new shortages of materials and inputs. Surging energy and commodity prices are reducing demand and holding back production. How the economy develops will crucially depend on how the conflict evolves, on the impact of current sanctions, and on possible further measures. At the same time, economic activity is still being supported by the reopening of the economy after the crisis phase of the pandemic. Inflation has increased significantly and will remain high over the coming months, mainly because of the sharp rise in energy costs. Inflation pressures have intensified across many sectors. At today's meeting, we judged that the incoming data since our last meeting reinforce our expectation that net asset purchases and our asset purchase program should be concluded in the third quarter. Looking ahead, our monetary policy will depend on the incoming data and our evolving assessment of the outlook. In the current conditions of high uncertainty, we will maintain optionality, gradualism, and flexibility in the conduct of our monetary policy. The Governing Council will take whatever action is needed to fulfill the ECB's mandate to pursue price stability and to contribute to safeguarding financial stability. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So turning to the economic activity. The euro area economy grew by 0.3% in the final quarter of 21. It is estimated that growth remained weak during the first quarter of 22, largely owing to pandemic-related restrictions. Several factors point to slow growth also in the period ahead. The war is already weighing on the confidence of businesses and consumers, including through the uncertainty that it brings. With energy and commodity prices rising sharply, households are facing a higher cost of living, and firms are confronted with higher production costs. The war has created new bottlenecks, while a new set of pandemic measures in Asia is contributing to supply chain difficulties. Some sectors face growing difficulties in sourcing their inputs, which is disrupting production. However, there are also offsetting factors underpinning the ongoing recovery, such as compensatory fiscal measures and the possibility for households to draw on savings that they accumulated during the pandemic. Moreover, the reopening of those sectors most affected by the pandemic and a strong labour market with more people in jobs will continue to support incomes and spending. Fiscal and monetary policy support remains critical, especially in this difficult geopolitical situation. In addition, the successful implementation of the investment and reform plans under the Next Generation EU programme will accelerate the energy and green transitions. This should help enhance the long-term growth and resilience in the euro area. Turning now to inflation. Inflation increased to 7.5% in March from 5.9% in February. Energy prices were driven higher after the outbreak of the war and now stands 45% above their level 1 year ago. They continue to be the main reason for the high rate of inflation. Market-based indicators suggest that energy prices will stay high in the near term and will then moderate to some extent. Food prices have also increased sharply. This is due to elevated transportation and production costs, notably the higher price of fertilizers, which are in part related to the war in Ukraine. Price rises have become more widespread. Energy costs are pushing up prices across many sectors. Supply bottlenecks and the normalization of demand as the economy reopens also continue to put upward pressures on prices. Measures of underlying inflation have risen to levels above 2% in recent months. It is uncertain how persistent the rise in these indicators will be, given the role of temporary pandemic-related factors and the indirect effects of higher energy prices. The labour market continues to improve, with unemployment having fallen to a historical low of 6.8% in February. Job postings across many sectors still signal robust demand for labour, yet wage growth remains muted overall. Over time, the return of the economy to full capacity should support faster growth in wages. While various measures of longer-term inflation expectations derived from financial markets and from expert surveys largely stand at around 2%, initial signs of above-target revisions in those measures warrant close monitoring. Looking at the risk assessment now. The downside risks to the growth outlook have increased substantially as a result of the war in Ukraine. While risks relating to the pandemic have declined, the war may have an even stronger effect on economic sentiment and could further worsen supply-side constraints. Persistent high energy costs, together with the loss of confidence, could drag down demand and restrain consumption and investment more than expected. The upside risks surrounding the inflation outlook have also intensified, especially in the near term. The risks to the medium-term inflation outlook include above-target moves in inflation expectations, higher than anticipated wage rises, and a durable worsening of supply-side conditions. However, if demand were to weaken over the medium term, it would lower pressure on prices. Financial markets have been highly volatile since the war began and financial sanctions were imposed. Market interest rates have increased in response to the changing outlook for monetary policy, the macroeconomic environment, and inflation dynamics. Bank funding costs have continued to increase. At the same time, so far there have been no severe strains in money markets, nor liquidity shortages in the euro area banking system. Although remaining at low levels, bank lending rates for firms and households have started to reflect the increase in market interest rates. Lending to households is holding up, especially for house purchases. Lending flows to firms have stabilized. Our most recent bank lending survey reports that credit standards for loans to firms and for housing loans tightened overall in the first quarter of the year, as lenders are becoming more concerned about the risk facing their customers in an uncertain environment. Credit standards are expected to tighten further in the coming months, as banks factor in the adverse economic impact of Russia's aggression towards Ukraine and higher energy prices. In conclusion, summing up, the war in Ukraine is severely affecting the euro area economy and has significantly increased uncertainty. The impact of the war on the economy will depend on how the conflict evolves, on the effect of current sanctions, and on possible further measures. Inflation has increased significantly and will remain high over the coming months, mainly because of the sharp rise in energy costs. We are very attentive to the current uncertainties and are closely monitoring the incoming data in relation to their implications for the medium-term inflation outlook. The calibration of our policies will remain data-dependent and reflect our evolving assessment of the outlook. We stand ready to adjust all of our instruments within our mandate, incorporating flexibility if warranted, to ensure that inflation stabilizes at our 2% target over the medium term. We now stand ready to take your questions. Thank you.
Thank you very much, President Lagarde. And today the first question goes to Balazs Korani of Reuters. Balazs, please.
Good afternoon. Thank you for taking my question, and good to see you, President Lagarde. We're wishing you a quick recovery. So my two questions. First one, could you give us a bit of a flavor for the discussion? Did some of your colleagues call for a more definite end date for the APP? And what was the clincher argument for keeping your formulation despite sharply higher inflation? The second question is about interest rates. Markets now price in 2 rate hikes this year and maybe as much as 8 hikes by the end of 2023. Are you comfortable with these expectations? Are these expectations consistent with your definition of gradual?
But thank you so much for your good wishes, and thank you for your 2 questions. On your first question, I would call your attention to a particular sentence in the monetary policy statement, which reflects the evolution of the Governing Council assessment of the current situation 5 weeks after the last monetary policy Governing Council meeting that we had, which is a very short interval as opposed to other periods. So it's the sentence that begins the second paragraph of the MPS, where we say, at today's meeting, we judged that the incoming data since our last meeting reinforce our expectation that net asset purchases under our asset purchase program should be concluded in the 3rd quarter. So there is a much stronger affirmation of our assessment of the data, which, as you rightly pointed out, have indeed changed since 5 weeks ago. Now, obviously, this meeting was not a projection exercise. It was an interim Governing Council monetary policy meeting. And we affirmed the net asset purchases very likely conclusion in the third quarter without being more specific, but being open-minded as to when in the quarter that is. It could be early, it could be late. The third quarter has 3 months. And I think the determination around the Governing Council table was to take stock of the projection exercise at the next monetary policy meeting to determine exactly the timing of such conclusion of the net asset purchases under the APP. On your second question about the how many interest rate hikes are projected by markets, let me tell you that we are sticking to our sequence. And this is very much what we did on the occasion of this Governing Council meeting. And the sequence that we have adhered to, that we have agreed, is complete net asset purchases first. And sometime after that, decide interest rate hike and subsequent hikes. And I remember last time around on the occasion of the last Governing Council monetary policy press conference, I think I was asked specifically what was meant by the sometimes after. And I'll repeat what I said at the time. Sometime after is intended to serve our determination to have both optionality, gradualism, and flexibility, which means that this sometimes after can be anywhere between a week to several months. And that stands and remains true. So we'll deal with interest rates when we get there.
Thank you, Madame Lagarde. And the next question is for Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you very much for taking my question. Also from my end, the best wishes for your recovery, first of all. Let me ask you about the potential effects of an oil and gas embargo on inflation and the economic outlook. Have you been discussing that? Is that something which you think is a realistic scenario? And my second question would be on how concerned you are about the tightening of financial conditions through the lending channel, but also the market is already, we are seeing yields on the rise for the corporate space, but also for sovereigns. Is that something you are concerned about? Thank you.
You know, on your first question concerning the potential boycott of oil and gas, and I'm assuming that you are referring to oil and gas out of Russia, and the initiative of the boycott being either one party or the other, the supplier or the purchaser. Let me just first of all state that this Russian war against Ukraine is not just causing economic problem, it's causing a huge humanitarian crisis, massive economic damages, and cost and risks way beyond Europe. I noted the joint statement by the president of international institutions to support that we all focus also on the food crisis that is going to be hitting low-income countries and other people than the Europeans. So let's put things in perspective first. But of course, on the oil and gas front, an abrupt boycott would have significant impact. And staff monitors that very carefully. Any such risk obviously reinforces the determination of the Europeans to move towards cleaner energy, to move to non-fossil fuel in general, and to reduce dependency vis-à-vis Russia. But have we actually factored in exactly the net amount, the trade-off resulting from any such boycott? No, we simply know that obviously some countries within the euro area would be more affected than others. And we also note that the Europeans together, under the leadership of the Commission, are looking at ways to adopt joint approaches, joint policies, joint purchases, which is certainly, together with moving to a different energy mix, is the right approach to take. On the second part of your question that dealt with the tightening of rate, I have commented on the bank lending survey, which indicates that there is, and there was during the first quarter, a certain tightening by a larger number of banks answering the surveys. All that being said, the volume of loans to households in particular still stands quite strongly. Lending to consumers, consumption loans, have increased, and corporate lending has stabilized for the moment. So even if there is tightening, particularly concerning the terms and conditions of those lending arrangements, in terms of both rate and volume, we're not seeing yet the outcome of this tightening that you referred to. Equally true that in the bank lending survey, respondents are indicating that they expect further tightening in the coming months, and clearly that is associated with the war in Ukraine, with the additional supply bottlenecks issues that will affect corporates in particular, and the general confidence impact that the war has on both corporates and consumers.
Thank you, Madame Lagarde. And the next question is for Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Good afternoon, and thank you very much for this opportunity and my best wishes. President Lagarde, I have two questions. The first question is on fragmentation and flexibility. At the moment, in the event of renewed market fragmentation related to the pandemic, PEP reinvestments can be adjusted flexibly. In case of renewed market fragmentation, but this time not related to the pandemic, but to war, sanctions, or recession, is the ECB ready to apply the PEP flexibility to APP reinvestments? I've seen you've mentioned incorporating flexibility. Does it mean you incorporate in existing tools, or are you studying new tools for fragmentation? My second question is on wage price spiral. How far is the Governing Council worried about a wage price spiral with inflation getting out of control? I've seen you've mentioned wages and it's muted, but it's coming. We are in Germany, and I think it would be maybe in a hot autumn. Thank you.
Thank you so much, and thank you all for your good wishes. I hope they work. Let me first of all, again, this seems like a rereading exercise, but I think it matters because those are parts of the sections of our monetary policy statement that were clear changes from the past and indicate a direction that we're taking. And this is actually something that you will find in the conclusion of the monetary policy statement, which is in the penultimate line. And it says, we stand ready to adjust all of our instruments within our mandate, okay, comma, incorporating flexibility if warranted, to ensure that inflation stabilizes at our 2% target over the medium term. This is language that you know quite well. But the overall sentence is something that is worth taking notice of. So, optionality, gradualism, flexibility are concepts that we have outlined before. So we are really very much in a normalization process, and we are continuing along the path of that normalization process. And it has been the case in the last couple of years, and particularly 2 years ago, if you remember, that flexibility served us well. And I think it's on the basis of that recognition of the value of flexibility, in particular, in order to make sure that monetary policy stance is properly transmitted and that unwarranted fragmentation is avoided, that we are recognizing this and we are mentioning flexibility as one of the principles that we want to apply. 2 years ago, you would remember, it was necessary and we moved promptly. We can do exactly the same thing. If necessary, we move promptly and we design, as I have said in my ECB Watchers speech a few weeks back, we will design whatever additional instrument is appropriate in order to deliver the flexibility that we believe is useful. I would add, as a footnote to that, that the reinvestment policy that we've decided for PEP back in December is actually coined with this flexibility possibility. So we've not only indicated that reinvestment would be extended until 2024, but we also said that if necessary, we would apply flexibility in the reinvestment policy. So I think that really captures the philosophy that we have in relation to flexibility and the need to properly transmit the monetary policy stance throughout the whole of the euro area. Oh, you had a second question. Yes, sorry. You had a question on wages and the possible second round effect. I think I've told you at the last press conference we had that we were particularly attentive to wages. And we continue being so because that's a critically important component to assess inflation outlook in the medium term and to help us determine our monetary policy stance and the need to move at a certain pace. We also look at inflation expectations very carefully. But on the wages, we're looking at it very carefully, and what we are seeing is a relatively muted wage increases. If you look at the latest numbers that are available, it's January, and it points to 1.6% increase. Now, this is looking backward, obviously, and we have to be particularly attentive to movements as they develop. And we know that the longer inflation numbers are at the high level where they are, the more likely it is that wages negotiations, salary entry levels, renegotiations of existing agreements will actually take place. So we had a good discussion on those issues at the Governing Council meeting. There are differences between countries. In some countries, it seems that unions or employees and employers are managing to reach agreement which take into account the risk of redundancy and threat to the economy. In other countries, there are much higher demands for wage increases and wage renegotiations. So we will continue to look at that extremely carefully and be attentive to potential second round effect as a result of that.
Thank you, President Lagarde. And the next question is for Alex Weber of Bloomberg News. Alex, please.
Good afternoon, President Lagarde. Thanks for taking my questions and also best wishes from our side. Firstly, I wanted to ask, how confident are you about the ECB's forecasting models and how accurately they can capture the current situation created by the war? And then on the new crisis tool that you just talked about and that the ECB is studying, how exactly would it complement the flexibility of PEP reinvestments and other measures like OMT that already exist? Thank you.
Do we have trust in the work that we do? Yes, we do. Do we get our forecast and our projections perfectly right all the time? No, we don't. And, you know, I spent a few years of my life operating with other forecasters and top-notch projectionists who didn't always get it right either. But do we trust that we monitor all the data that we need to monitor, that we apply all the economic wisdom that we can, that we use as many possible models as are available, that we try to improve on the economic results that we produce? Yes, we do. Did we make a mistake? Did we get it wrong in the past? Will we get it wrong in the future? Very likely. And this is particularly the case. So we have to be a little bit humble in that respect. We have to be cognizant of the fact that when there is a war, when there are major developments that are not predicted, that are not part of past patterns, it's incredibly difficult to actually integrate that into the models that help us offer projections to our European colleagues. And the same is true for national central banks, by the way, and the same is true for many, many projectionists and for many forecasters. So we have that humility, and we recognize that we have to not only look at forecasts and models, but also look outside the window and try to figure out what is happening and what is the likely impact. Looking at past history is not in and of itself sufficient. And as I said, you know, who knows what impact and development the war is going to have on our economies. On this issue of flexibility and the fragmentation issue and the need to make sure that monetary policy is transmitted in an unimpaired fashion, you know, we constantly try to improve on the toolbox. We constantly look at, you know, what works, what will help us provide the flexible, efficient, and proportionate response to the situation. And this is what is going to continue to happen in the future. So I'm happy to repeat again the value that we give to flexibility and the need to embed flexibility in order to make sure that we transmit monetary policy throughout the euro area. But this is what our work is cut out for. Thank you.
Thank you, President. And the next question for Jean-Philippe Lacour of Agence France-Presse, AFP. Jean-Philippe, please.
Yes, no. Good afternoon, Madame la Présidente, and my wishes of bon rétablissement, we say in our mother tongue. So a follow-up question to now to your answer on the validity of the forecast and that we must remain humble in this exercise. What should we draw? And so what should we conclude about the way then you are going to decide in the next future of the monetary policy regarding this high level of uncertainty we have? And my second question, I hope not to make you lose your voice. In France, we have this presidential election, which is in the final round, and your name, Mrs. Lagarde, is less associated with the next announcement on monetary policy and so on, and with this rumor which designates you as possible head of a future government, if they are founded or not. What do you respond to that?
I lose my voice. Let me deal with the real and the good question that you ask. And this is not me withdrawing the need to be humble in the face of what our projections can offer. But obviously, in deciding, in particular next June, because that's going to be our next projection monetary policy meeting, in June, we are going to look at our projections. And as you will remember, back in March, we had projections that included a baseline and a couple of scenario analysis as well. One was severe, was one adverse. I don't know exactly whether we're going to come up with, a similar exercise with one baseline and two scenarios, whether we're going to have one baseline, one scenario, some sensitivity analysis in particular areas where we believe that we need to pay special attention. Wages is clearly one that comes to mind. Inflation expectations, another one. So we will use that, of course, because it's there. It has to be used. It is informative. But I think when I referred to humility, I meant we cannot be exclusively and only riveted to the projections produced by our models. We also have to look at actual data. We have to look at historical developments of similar situations and have an element of judgment in our assessment of the situation. But what we see at the moment is certainly reinforcing our determination that in the medium term, our outlook for inflation is at around 2%. And if there is one other section that I would like to refer you to in the monetary policy statement, it's one that is just before the risk assessment, which deals with inflation, where we say, while various measures of longer-term inflation expectations derived from financial markets and from expert surveys largely stand at around 2%, initial signs of above-target revisions in those measures warrant close monitoring. So we will be looking, of course, at our projection. We will be looking at actual data. We will be looking at historical experience, but we will also be looking very carefully at market and expert surveys, in particular in relation to inflation expectations. Because the last thing that we want is to see inflation expectations at the risk of de-anchoring.
Thank you, Madame Lagarde. And now a question for Martin Arnold of the Financial Times. Martin, please.
Hello, and bonne récupération, Madame Lagarde, from me. I hope you get well soon. I have two questions. This new instrument, which you allude to in the introductory statement, could that be described as a spread control measure? And the second question is, given that you have said the upside risks on inflation are intensifying, why has the Governing Council not accelerated its plans for ending net asset purchases and opening the door to the first interest rate rise? Thank you.
Well, thank you very much, and thank you for your good wishes. De bonne récupération. I did not announce any kind of new instrument. I did refer very specifically to the last sentence of our conclusion, which says incorporating flexibility if warranted. So flexibility is a principle that we believe has served us well, that we need to continue to integrate in our monetary policy determination, if warranted, if required. And as I said, if necessary, we can move very promptly. But I did not say that we were building a new instrument. We can certainly do that, and we can do it in short order and are capable of being operational, as we have demonstrated between the 12th and the 18th of March 2020, for instance. You asked me about the, let's see, you asked me about the access, yeah, you said, given, essentially what you said is, given the numbers that we're facing, given the situation, why did you not accelerate more, right? So, it gives me a chance to remind all of us that we are in a process, and that process started back in December. December, we announced that we were putting an end to PEP, that we were reinvesting, that we had a policy of reinvestment of PEP that would extend to 24, that we would apply flexibility. In February, I communicated that we were going to accelerate a bit, and March certainly was a strong signal of what we were considering in terms of terminating our net asset purchases under the APP. And I think that we are being a little bit more specific now in terms of what we see and the likelihood of this happening in Q3 at any point in time. So we are normalizing. We have a sequence that we've identified. We have numbers that have been flagged for purchases in those next few months, and we have now an ending point, which is a quarter at possibly a point in time during the quarter when we put an end to net asset purchases. As to your question on spread, clearly we need to make sure that our monetary policy stance is transmitted throughout the entire euro area. And this was the tool that we built with PEP back in March 2020. The sort of first part of the birth certificate of PEP was anti-fragmentation. Second part was monetary policy stance. And we were delivering that product in short order. It has proven very efficient. And I think it is, learning from this and recognizing that flexibility is important, that we will continue to deliver our monetary policy going forward.
Thank you, President. And now a question for Michael Rasch of Neue Zürcher Zeitung, NZZ. Michael, please.
Thank you. Good afternoon, Madame la Présidente. Also good recovery and good wishes from our side. Two questions, if I may. In Lithuania and Estonia, inflation is around 15% and has been in double digits since December. At this level, purchasing power halves in less than 6 years. What do you say to the people in these countries? And secondly, as we all know, inflation in the Eurozone as a whole is 7.5%, but the ECB interest rate level is light years below a neutral. So a growing number of observers now considers a restrictive policy to be appropriate. Is the ECB too late or much too late? Thank you.
Thank you for your good wishes and thank you for your question. We are on a journey. And clearly, as I said, we started the monetary policy normalization journey back in December, reconfirmed in February, clearly indicated in March, and we are restating this determination on the occasion of this monetary policy meeting. We have, as I said, added a few particular attributes to the decision that will be made in June when we have the next projection round, which is when we can take stock and actually assess exactly the timing of the conclusion of our net asset purchases, which will then trigger sometime after the end of the net asset purchases, interest rate hikes. So the journey has begun. It is moving along as predicted. We want to have both flexibility and move gradually and keep all the options open. We have to be mindful of the fact that not only do we see very high inflation rates, clearly, in some countries much higher than in others, but on average 7.5 is a very high number. But we're also seeing a medium-term outlook for inflation gradually moving back to closer to our target, to 2%, and possibly from above rather than from under. But these will be better advanced and better documented at our June next monetary policy meeting. But we are on that journey.
Thank you, Madame Lagarde. And the next question for Tom Fairless of the Wall Street Journal. Tom, please.
Thanks very much for taking my question. Sorry, just put my camera down.
I can't see you.
The top of my head, at least. So yeah, I had a question about quantitative tightening, and the Federal Reserve in the US is starting to talk about reducing its bond holdings, not just stopping bond purchases, but actually reducing the balance sheet. Probably they could start next month. Is this something that the ECB is thinking about, or is the EU thinking about? And my second question was on this normalization process, just following up from the previous question. So normalization suggests that you have an idea of what normal is in terms of the neutral policy rates. What do you think that is? And is normalization enough, or do you think you have to go above it? Thank you.
Well, thank you so much. First of all, you gave me a chance to actually yet again clarify that what is happening in the economy of the euro area is very different from what is happening in the economy of the United States. Whether you look at employment, whether you look at wages, whether you look at actually the general attributes and instruments of the monetary policy at the moment in the United States, our economies do not compare. And if anything, I believe that this is likely to be accentuated by the fact that the euro area is probably going to be more exposed and will suffer more consequences as a result of the war by Russia against Ukraine. The United States will not bear as much the brunt of the consequences from an economic point of view, I would suspect. So we cannot just, comparing our respective monetary policies is comparing apples and oranges. We're not applying policies to the same economic situations at all. When I talk about normalization of monetary policy, I think of the kind of instruments that we're using. I think about the rates that we have in place. I think about the use of our balance sheet, and I think it is very much in that order that we will be looking at normalization of monetary policy. It's a bit premature because, as we did during the Governing Council today, we looked at the short term, what limited updated numbers we have, and what qualification of our stance there should be as a result in terms of signaling what we will do next during the third quarter of 2022. Quantitative tightening is something that comes clearly at a later stage in that journey, and we are not there yet. The sequence that we have adopted, which is embedded in our strategy, which is very familiar to you, is net asset purchases have to conclude first before we decide on whether we hike interest rates and by how much, and then we will look at balance sheets. But for the moment, we're more thinking about the reinvestment policies that we have agreed both in relation to the APP and the PEP portfolios.
Thank you, Madame Lagarde. And the next question is for Francesco Ninfole of Milano Finanza. Francesco, please.
Thank you. Good afternoon. Best wishes. President Lagarde, do you think that the additional flexibility or the new tool should be launched before the end of asset purchases to avoid fragmentation? And secondly, could you explain how and through which channels ending asset purchases in the third quarter will help to reduce inflation, which is driven by energy and without second-round effects on wages and expectations until now? And how normalization will help achieve ECB's mandate in the medium term, given the ECB's projections show inflation at 1.9% in 2024, but at 1.6% in the adverse scenario. It seems that in some way the ECB's target is still below but close to 2%, and that the ECB has a short-term orientation on inflation more than a medium-term one. Could you clarify that? Thank you.
Well, thank you. Thank you very much. In relation to flexibility, I think I've been very clear to indicate that we believe that flexibility is helpful. We have seen it being very operative back 2 years ago. It is now specifically mentioned as something that will be incorporated if warranted. So it's totally premature at this point in time to indicate when any such flexibility will be deployed. The purpose of the flexibility is to make sure that monetary policy is properly transmitted throughout the whole of the euro area. So if and when it becomes necessary, we will know what to do, if necessary, and promptly, and it will be operational. On your other question, do we believe that net asset purchases will reduce the price of oil? No. Who would, in their right mind, think so? But it is also obviously the case that we have to be attentive to the inflation shock, to the impact that it has on wages, to the consequences that it could have on inflation expectations. And for all these reasons, we believe that in sequence, it is necessary, given the financing conditions, by the way, as well, that it is necessary that we put an end to net asset purchases. This is a very high probability, let's put it that way, because we have not decided it as specifically as that, but the wording of our second paragraph in our monetary policy statement is sufficiently clear to indicate that at this point in time, we believe that there is a very high probability and that it could happen any time during the third quarter. And it is for those reasons that we believe that it is our duty in order to ensure that inflation stabilizes at 2%. And, you know, based on the scenarios of last March, you're right that 2024, which is not necessarily the medium term, but the end of our projection, it moves between around 2 and a little below 2%. But I think that our forward guidance will be determining and helping us determine at the June projection meeting if we decide to terminate net asset purchases, what exactly will be the policy going forward in terms of rates.
Thank you, Madame Lagarde. And the last question goes to Les Commons of Market News International. Afterwards, all the questions are exhausted that I have on my list. So Les, please, over to you.
Thank you very much indeed. And President Lagarde, best regards and best wishes to you from this side of the channel as well. A couple of quick questions. The first one, again, going back to the fragmentation arguments and the fragmentation questions. We again say that you again said in the statement today with the PEP being related and tied into the pandemic as to how the flexibility is very much tied into the pandemic, the flexibility of it. How does the ECB policymakers decide, can you split out where the pandemic is the effects or other incidences the effect, you know, where is the war the main cause for the inflation concern perhaps, or where perhaps is the pandemic? So where is the dividing line? How do you strip out the two differences to use the flexibility for the PEP there? And the second one focuses on the euro, again sitting not far above 5-year lows. Certainly a few governing council members have expressed concern over the level of the euro in recent weeks. How great a concern is the level of the euro for the governing council, particularly regarding imported inflation, and what are the easiest things to do to address it? Thank you.
Well, thank you very much. And thank you for your good wishes. To the risk of repeating myself, you know, the specific role of flexibility will depend on the concrete circumstances that we face. We decided in December that in the event of renewed market fragmentation related to the pandemic, reinvestment under PEP can be adjusted flexibly over time, over asset classes, over jurisdictions. And I think those same principles would apply to the flexibility that we would want to develop and deploy as applied to other sets of circumstances. We can design and we can deploy new instruments to secure monetary policy transmission as we move along the path of policy normalization. We have shown that on many occasions in the past. Staff is extremely good at not only thinking on their feet, but also providing proposals in short order, and I know that they will be able to do so. This is what flexibility will be about. It's you know, in situations that demonstrate unwarranted and exogenous causes that impair monetary policy transmission, that will lead us to use those flexibility aspects of instruments or program that staff will be working on. On your second issue concerning FX and exchange rate, this is not a matter that we have discussed, but as you know, we are always attentive, not on the occasion of this Governing Council. But this is obviously a matter that we are attentive to because it does have an impact on inflation. And inflation is obviously the key of all our concerns, given its magnitude and its potential impact on second round effects and inflation expectations, and in view of our mandate, which is to maintain price stability and to deliver inflation at target.
Thank you, Madame Lagarde. This concludes today's press conference. Thank you very much for your interest. The next scheduled press conference is on the 9th of June. Until then, we wish you all the best. Thank you very much.